Investing in the stock market is really not as complicated as it looks, but I feel like a lot of the beginners out there are making the exact same mistakes, and these are mistakes that I've made too when I was a beginner, so I just want to clarify all of these mistakes so that we can do a better job as beginners. So in this video, I'm going over the 7 biggest investing mistakes that beginners make in the stock market so that you guys can avoid them and start off doing something a lot better. Now, if you just found this channel, I'm Jason with Honest Finance, and I make a lot of videos on different topics that'll give your life and your finances more value. So definitely subscribe if you're into that type of content. But for now, let's just start talking about the beginner mistakes in the stock market. And before I get into everything, I just want you guys to know that I am not a professional trader by any means, so just take this advice for entertainment purposes only. However, it is my opinion, and I do think it'll help you if you're a beginner in the stock market. Okay, so the first mistake that I see a lot of beginner investors making is just the fact that they have got a lot of high interest debt in their personal lives, and then they're investing on the side, and that is not something you want to do. You do not want to have high interest debt while you're actually investing in the stock market. I really have no problem whatsoever if you want to invest like $200 into the stock market, even if you have high interest debt at home. But the point is that I don't want you investing more than that, because if you've got a credit card that has 18% interest, you need to pay that sucker off before you start investing any more money in the stock market. And the reason this is a big mistake is because if you look at the history of the S&P 500, it's only averaged about 10% through all the years. And then if your credit card is 18%, then that means that you're just going to be losing 8% more than what you can actually accomplish on the stock market as an average. So definitely don't do that. Get your credit card paid off first and then start investing your money in the stock market. And also, I know that this contradicts itself, but if you work for a company that offers a 401k match, then I would definitely take full advantage of it, because that is a 100% return on your money, even if you have high interest debt at home. Your retirement is so important for your future, so please make sure that you take care of your debts responsibly, and if you do have a 401k match, take full advantage of it, because it is definitely worth doing so. So just remember to take care of all of your high interest debt first before you start investing a lot of your money into the stock market. That way the numbers add up and you're actually going to end up making money. Now, the next big mistake that I see a lot of beginner investors making is just the fact that they base their moves on speculation, news, and then different forums and things that they read on the internet, and they base everything off emotion rather than long-term strategy, which is something that they're just not doing. You definitely don't want to be making a bunch of different moves emotionally because of what someone else told you, because if you have a strategy in place, you just need to stick with that, stick with your gut, and you're going to be a lot better off. And then a quick tip that I want to add is that you should always be keeping long-term goals, because you're never going to get that emotional if you're looking 5 to 10 years out versus what you're seeing today, tomorrow, or next week, because those are all going to be going up and down all the time. And if it's 5 to 10 years out, it's just not that big of a deal when things fluctuate quite a bit. There's also huge tax benefits for keeping your shares for longer than a year, because you're going to be taxed on what's called long-term capital gains. So just keep that in mind. I'm not going to elaborate very much, but if you keep your shares longer than a year, there are tax benefits for doing so. Now, the next mistake that I see a lot of us making is that a lot of the big brokerages out there actually charge trading fees. So if you're going to buy shares or sell shares, you have to pay a trading fee, which is just a total waste of money nowadays, because there are a lot of brokerages that do not charge trading fees. I mean, the free brokerages probably won't have 24/7 call centers if you ever run into an issue. So as long as you're okay with email and waiting a couple days to get something solved, then definitely go ahead and just stick with the free brokerages, because those free trades are definitely worth it. All of the free brokerages have their pros and cons, but right now I definitely prefer using Webull because they have the best sign-up bonus. Because if you sign up with them, you can get 1 free share just for signing up, and that's going to be worth up to $250. And then if you deposit just $100, then you can get another share that's worth up to $1,000. So if you do that, you can actually get 2 free shares with them, and that's the best sign-up bonus that I've seen for all of the free brokerage accounts. Now, if you are interested in signing up for Webull, I've got an affiliate link in the description below, which means I may be compensated if you click through it, but just keep in mind that this is definitely the best sign-up bonus that I've found for all of the different free brokerages, and I have been using them for quite a while now, and I really do like them, and they have a lot of robust features that the other apps don't have. And then also, if you're the type of investor that wants to use a financial advisor, that is totally fine with me, but just pay attention to the expense ratio, because a lot of financial advisors out there charge between about 1% and 2%, which is a lot of money if you have a lot of money in the stock market. So just pay attention to the expense ratio, keep that as low as you possibly can, and you're going to be a lot better off with your financial advisor. So just remember that there's a lot of brokerages out there that don't charge any trading fees, and then if you are going to use a financial advisor, just make sure that the expense ratio is super low. Now the next mistake that I see a lot of beginners making is that they are not diversified, which means that they just go big on just a few different companies, and then if anything goes wrong, it seems like everything goes wrong because they only have a few in their portfolio. Honestly, it's not that bad of a strategy to just have a few companies that you're invested with, but the problem is when you're a beginner, you're going to be too emotional, and so if those stocks go up and down too much, you're just going to make some moves that you really don't want to be making. I'd recommend investing in ETF indexes like the S&P 500 because that way you're going to have 500 different companies that you can be looking after, and if something goes wrong, it's probably not going to affect you that much. And then once you have some ETFs, then you can go ahead and buy into some individual companies if you want to, but at that point, then you're going to be diversified. And if you guys have made it this far into the video, can you please comment down below and just say, I got it? That way I actually know if I'm making sense about what I'm talking about. Thank you very much. Now the next mistake I want to talk about is very simple, and that's just the fact that you shouldn't be investing in companies that you don't understand. This is really important because I feel like the more you know about a company, the less likely you are to get super emotional if their shares go up or down in the market, and then that way you can actually stick to your long-term goals, and it's going to be better for you in the long run. And even if you don't understand a company very well, it's still a good idea to at least know who they are, because then you at least have a start of something that you understand just a little bit. I mean, think of it like this. Without looking at any data, you could say that you know who Disney is, and you could probably assume that they're a healthy company that's only growing. And so therefore, just because you know who they are, that's a much better start for something because you at least know what they are, what they're about, and probably where they're headed. So just the fact that you already know who Disney is a really good start, because you don't want to just invest in some random gold mining company out of Kansas just because it seems like a good investment. Now the next mistake that I see a lot of beginners make is that they buy shares of companies just because they feel cheap, because they don't cost very much money, but that doesn't mean anything as far as whether it's a good value or it's not a good value. So for instance, if you were looking into a company and their shares were only $8 a piece, that might sound like a good value because it's something that you can afford, but the problem is that there's a lot of different factors that go into the share price, and it might actually be a complete ripoff, and you just don't know it at that point. Because think of it like this, if you were going to go buy a 20-ounce soda, you generally know that those cost about $2 to $3. So if you went to Walmart and one of their sodas was actually $8, you would instantly know that that was a ripoff because you already knew that they're supposed to be about $2 to $3 whenever you buy them. So therefore, in the stock market, if you're buying an $8 share, you need to understand what its true value is supposed to be so that you can tell if it's a ripoff or if it's a good value. Because the problem here is that all of us can afford an $8 soda, but that doesn't mean that it's actually a good value. So just keep that in mind whenever you're shopping on the stock market so that you don't buy something that's overvalued. You actually want to buy it when it's cheap and low. And honestly, the easiest way that you can do this on different shares is just to check the price history over like the last 5 to 10 years. And then that way you can see if it's high or if it's low, and that can give you a very basic idea of whether you're paying too much for the share or not. And keep in mind that there's a lot of other factors that play into whether or not a share is a good value or not. So just keep in mind that there is a lot to do when it comes to researching a company. But from a very shallow point of view, you can either check the PE ratio or their history like I just talked about. So just keep in mind that you want to buy low and sell high, and that's always something that you can definitely keep in mind. And then the last mistake that I want to talk about is the fact that a lot of investors will actually borrow money to invest in the stock market with money that they don't have. So if you're borrowing money from your family or your friends to invest in the stock market, that's not a good idea, but I'm specifically talking about margin trading, which is something that you can do with brokerages, where you can borrow money from them and then you can pay them back at an interest rate to invest back into the stock market. There's a lot of investors out there that use margin to their advantage, but the problem is that if you're a beginner, you're probably going to be making too many mistakes in the beginning, and that is not something that you want to be taking any risk for, especially when you don't have the money to lose. And then when it comes to your own budget, I definitely want you only investing money that you can afford to lose. So when it comes to your family and things like that, make sure that you take care of your responsibilities first and then invest after all of those are taken care of. So just please understand that there is risk when it comes to investing, but I can promise you if you do it responsibly and you stay away from a lot of these different types of mistakes, you're going to be better off in the long run. And that's the whole point of investing, is that it is long term, and that's what you're looking for. You're looking into the future. Well, hopefully you guys learned something from this video, because once again, I'm Jason with Honest Finance, and I make a lot of videos on different topics that'll give your life and your finances more value. So definitely subscribe if you guys are into that type of content. But for now, I'll just leave some more investing videos that you guys can watch, or you can just move on with your lives, do whatever you want. But thanks for watching.